We have a lot of investors watching and real estate agents that work with investors. Many of them are not necessarily worried, but they're also not fully in. So if an investor came to you now and said, okay, we know what we're dealing with now, there's a little bit of uncertainty, but looking a little bit down the road, should I invest? What do you say? How is the market looking right now for investors?
Market is, I think.
Are we recording? Welcome to another episode of Rubbing Elbows. The market is crazy. Everyone's crazy, but we have the answers. Today on our episode, we have Rick Sharga.
RealtyTrac.
He's the VP, right?
He's the executive VP.
Executive VP of RealtyTrac.
Yeah.
And he has all of the data that we always want to know. What's happening in the market? Where are the foreclosures? Where are the hot states to invest? Well, he's going to answer all those questions. So we're going to jump into the episode that we recorded with him. If you have any questions, make sure to put them in the comments below. And anything else, Chuck, before we jump right into the episode?
I would just say get your pens and notepads ready and write down these statistics, write down this data, because knowledge is power. And you knowing some of these things that your competition might not know is going to give you the edge.
Well said. Well, here we go. Jumping right into our episode with Rick Sharga. All right. So now we have a very special treat. We have, Chuck, why don't you introduce our guest speaker for this week?
We've got Rick Sharga, Executive VP of RealtyTrac. Where is he? Let's put him on.
Hey, Rick, how are you?
Hey.
Doing great. Thanks for having me today.
Yeah, so tell us, obviously everybody is concerned right now. The market is uncertain, for lack of a better term. Rates are going up. People are, afraid of waiting, but also afraid of jumping in because, for the last couple of years, a lot of people are saying, okay, we're at the peak, and it's still kept going up. So why don't you tell us a little bit, first of all, maybe about what you guys do, what RealtyTrac is, and then maybe your outlook on the market.
Sure, I appreciate that. RealtyTrac publishes the country's largest database of distressed properties, foreclosure properties. We're typically used by individual investors and real estate professionals who are looking for those off-market and below-market deals. We've been around since 1996, so the company's been there for a long time. We're owned by a company called Atom Data Solutions, which sells massive amounts of real estate and mortgage-related data, school information, climate information, all sorts of information related to that. So we're up to our neck in data when it comes to these markets. In terms of the housing market, we've had people talking about the market peaking now for, I believe, 119 consecutive months. So it's been almost 10 consecutive years of year-over-year price increases. And honestly, given the lack of supply available and how much demand there still is for housing, we don't see that changing anytime soon. The demographics just say that we're going to continue to see household formation. A high percentage of those households being formed are going to be owner-occupied households. And so the demand, the sheer demand, is going to continue to keep home prices at least from falling. One thing you did point out is mortgage rates have gone up almost a full point year over year. That has an impact on affordability, as do home prices. So there are probably some people that are going to get hit and now not be able to afford that home purchase. As that happens, as we hit that affordability wall, hopefully what happens is home prices start to come down a little bit, not necessarily dropping, but at least the rate of appreciation slowing down. And that's normally how these market cycles work. The war going on right now in Ukraine could temporarily result in mortgage rates going down. So something your listeners, your viewers might want to be watching for is a dip in mortgage rates because a lot of investors during these volatile times will invest in U.S. Treasuries. That lowers the yields on Treasuries, and those yields are what determine mortgage rates. So
I'm so sorry for jumping in. How soon do you think we can see a dip like that? Because some are saying the war is kind of ending before it's starting because Putin overplayed his card, and then then it gets political. But just from a data standpoint, how quickly do you think we would be able to see some sort of a dip?
Yeah, gosh, I hope that's right, and that we see this war subside almost immediately. That'd be better for everybody. We've actually already seen yields dip a bit on the Treasury bonds. There was a lot of flight to Treasuries instantly when this happened. And Freddie Mac announced that interest rates have dropped at least a little bit from the high they hit last week. So I would think right now would be a good time to be looking and to be shopping around for mortgage rates because whatever drop we do have, unless the war continues for some extended period of time, I think whatever drop we have in mortgage rates is going to be very short and very temporary. So interestingly, that we've seen interest rates rise faster this year than most economists had predicted. Most of the people I talked to said we'd end the year at about a 4% interest rate for a 30-year fixed rate loan, and we hit that in the first quarter. And that's mostly due to inflation and the market pricing in the Federal Reserve doing a couple of rate hikes over the course of the year. So it'll be interesting to see how this all plays out.
So, I'm curious to know, and I think you kind of answered this in your previous comments, but the main question people are asking that are sitting on the sidelines right now is, will there be a wave of foreclosures like we saw when the market collapsed in 2007-8? What is your data saying?
Our data is saying don't count on that. If you shake the magic 8-ball, the answer you get is it doesn't seem likely. For those of you old enough to remember the magic 8-ball. So the number of homes in foreclosure today is about 220,000. In a normal year, that number would be about 550,000, given the number of active mortgages that are out there. So
is
we're
it California or?
No, that's nationally.
220,000 nationally?
Nationally, yes.
Wow, that's like nothing.
Yeah, normally about 1% of loans are in foreclosure. So there's 55 million loans. We'd normally be seeing about 550,000 loans across the country in some stage of foreclosure. So we're below half of that right now. And that's even with a pretty big increase in foreclosure activity in January. So my speculation and what we're seeing at RealtyTrac is that we'll continue to see foreclosure activity increase month to month for the rest of the year, but we probably won't get back to normal levels until the end of this year or even the beginning of 2023. So,
but how much of that is being swayed by the COVID and the moratorium of banks not foreclosing, maybe when in a normal situation they would have?
So the forbearance program that was part of the CARES Act that came out right when the pandemic was declared has probably prevented between 3 and 4 million unnecessary foreclosures. When I say unnecessary, it's foreclosures that wouldn't have happened except for COVID-19. The people that have exited that program, about 85% of them have continued to make on-time payments since June of 2020. So there was a belief that forbearance was going to lead to foreclosure, and that simply hasn't been the case. But no, the economic recovery, honestly, is what's keeping the foreclosure numbers low. GDP in the first quarter grew 7%. We've actually regained almost all the jobs we lost during the pandemic recession. And the only jobs that haven't been recovered are in the service industries where most of the employees are renters, not homeowners. So usually you can connect the dots between unemployment rates and delinquency rates and foreclosure rates. And unemployment rates now are down to almost where they were before the pandemic hit. So it really is the economy that's keeping foreclosures lower than you'd expect.
So you're obviously living in the data, right?
Yeah.
And we just hear things, from just being involved. I'm obviously in the lending side, Chuck's on the real estate side, but we hear things, we talk to people, but we're not living the data. One thing that I've been hearing in the last couple of years, and I'm curious your opinion on it, is we're not playing by the same set of rules, meaning historically what used to matter doesn't apply as much anymore. Is that an accurate statement as far as being able to look at history and predicting what would happen? We're not playing in the same type of global economy anymore, so you can't really rely on history as much. Is that an accurate statement?
Yeah, we've actually seen this twice now. If you go back to 2008 to 2012 when we had the market meltdown, what led to that was pretty bad lending practices. Hopefully not by you guys. And
I'm still here.
yeah, so it wasn't you. But people getting, negative amortization loans, which is like giving a 4-year-old a bazooka and hoping nothing bad happens. And so the normal rules didn't apply anymore. You couldn't tell what was going to happen next because the market dynamics were all screwed up. Market dynamics this time are very different than they were 10 years ago. So the behavior should be a little different, but it is hard to predict what's going to happen this time based on the last cycle because the situations are like night and day. We had an overbuilt housing market last time, too much inventory. Lenders weren't making loans, and the loans they had been making were pretty bad. The loan quality right now is extraordinary. That's why we have such a low level of foreclosures. And there's not enough inventory to meet demand, so home prices are going up. And we were talking about this offline before we got started today, but even what you see in terms of activity on the MLS is a little misleading because we're seeing a lot of properties that are effectively being sold, or at least there's a deal in place before they even get listed on the MLS. So it's really tough to take a look at this data and not put, a big asterisk at the end of it and say, this is our best guess.
I'm curious if you don't have a question, I want to jump in because we have a lot of investors watching and real estate agents that work with investors. So, if an investor came to you, because I talk to a lot of them, and many of them are not necessarily worried, but they're also not fully in. So if an investor came to you now and said, okay, we know what we're dealing with now, there's a little bit of uncertainty, but looking a little bit down the road, should I invest? What do you say? How is the market looking right now for investors?
Market is, I think, very ripe for investors who know what they're doing and who buy intelligently. We survey investors, and these are mostly individual investors, every quarter. And in the last year, we've seen the percentage of people who fix and flip versus the percentage of people who buy properties and rent them shift, where it used to be more fix and flip investors, and now it's almost 2-to-1 rental investors who are active in the market. And that probably reflects available inventory and market demand. And we're seeing a lot of that activity moving out of the coastal states and into the Southeast and the Midwest of the country where properties are more affordable. So, there's an old saying in real estate that the best time to buy real estate was probably 15 years ago, and the second best time is today. Because if what you're looking for is market prices to come crashing down so you can buy it at the lowest point of the market and get your returns going from there, probably not going to happen. The demographics, the market imbalance of supply and demand, just the relative value of those fixed assets, brick and mortar collateral, all weigh against a huge market crash happening again anytime soon. So if you're an investor and you can afford a property, you don't want to overpay for it, especially if you're a fix and flip investor, you don't want to overpay for it. But if you're a rental investor, your time horizon is probably not 2 to 3 years. It's probably 5, 10, 15 years. Ultimately, your home price is going to appreciate beyond what you paid for it. And you should be buying it so that you're making your profit on your cash flow. So, a good time to invest is going to be very different market to market. You have to know what you're doing and be careful about not overpaying or not buying a rental property in a market with high vacancy rates. So as long as you know what you're doing, educated investor, the time is not bad for you to be buying. And by the way, interest rates, if you're financing, are still relatively low. They're not as low as they were a year ago. But if you told me you could get private financing, hard money lending for, less than 10%, 5 years ago, I would have told you were crazy. And that's not a stretch these days at all.
We actually had a question regarding investors buying properties that are tenant occupied. Any takes on that?
Yeah, I mean, look, if you're going to be a landlord, you have to know what you're getting into. And there are certain states like California and New York that are not particularly landlord friendly. There are certain jurisdictions within those states, like New York City, like Los Angeles, like San Francisco, that are particularly rough on landlords. So if you're buying a tenant-occupied property, and this is especially true today when there are still some eviction bans in place due to COVID-19, you really do want to make sure you know what you're getting into, and a good deal can turn sour really quickly if you're counting on cash flow and your tenant's not paying you, and you can't evict that tenant and replace the tenant with somebody who's going to pay their rent. That said, if you're an experienced investor, if you have a portfolio of performing properties, and can afford to make payments on a property with one tenant who's holding out on payments, you could probably get some good deals on those properties from investors who can't afford to hang on to those properties because of non-payment. So it really depends on your personal situation, your personal finances, and candidly how long these tenant protection laws are going to be in place that allow people to stay in those properties without making payments.
So let me ask you, because you're obviously seeing data nationwide, what are some of the hottest cities for investors, or where you're seeing investors being able to get a better rate of return and less headaches in terms of, being more landlord-friendly states and things like that?
I would be hard-pressed to give you specific cities, but I can tell you that states in the southeastern part of the country are where a lot of investment money is flowing right now. Tennessee, the Carolinas, Florida, a real hotbed of investor activity right now for both rental properties and fix and flip properties. Alabama, which would probably surprise some people, a really good market. If you're looking for cash on cash returns on rental properties, the Midwest is a hotbed right now. Looking at states like Michigan, looking at states like Indiana, places where you wouldn't necessarily think of first. But I know investors who are looking at monthly cash on cash returns of 15 to 18% in some of those markets. So you're looking for a market where you can buy a property affordably. And in Michigan, Detroit area, you're buying properties for really pennies compared to what you would spend in a California or New York. And then you can rent the property out at $900 a month and make a pretty good investment return.
Are you seeing any data on commercial, or is it just residential?
We do see a little bit of data on commercial, and we have seen surprisingly little foreclosure activity considering what a beating the retail and hotel markets have taken. But we've also seen an uptick in sales of retail and hotel properties, particularly small hotel properties. And what that says to me is those were owned by relatively small investors who didn't have the financial wherewithal to get through a couple of years with high vacancy rates in their hotel properties. So there are probably some good deals to be had in small dollar commercial, retail, and hotel properties for your viewers who are interested in that segment.
So, I do want to ask you one final question before we wrap up, and I appreciate you taking the time. I know it's crazy times right now, and you're probably very, very busy. But in terms of when it gets to investment opportunities, you mentioned a lot cash on cash, rate of return. How do people invest in, coastal property states when taking that into account from an investment aspect?
Unless you're extraordinarily wealthy, you're going to probably wind up financing anything you buy in a state like California, along the coast, Pacific Northwest, even a handful of other markets across the country where prices have really accelerated. So in those cases, you really need to manage your expectations very carefully. I got a note from, I get a bunch of stuff from different real estate sources, and I got my monthly note from Zillow telling me what I could get to rent my house. And the rental rate is about twice what I pay for my mortgage. And it struck me as being odd that there'd be a lot of people willing to pay that much to rent a house. So I do think, the more expensive the properties you're looking at, the more likely you are to be in a fix and flip mode rather than a rental mode. And there is a demand for properties from owner occupants, but you got to manage your finances carefully. You got to minimize your repair costs because you're not going to be able to mark up your property as much in today's market. And you need a finance partner who's going to be giving you the best terms you can get for that kind of bridge loan. So
And
it's a little
patient.
bit,
They need to be patient too.
they really, and you're right, it's a numbers game. You can't fall in love with a particular property and then overpay for it. You've got to be able to manage your own expectations. And if the property comes in at above what you think is a reasonable number, you got to move on to the next property and just and bide your time.
All right. Well, there you go. You heard it here first. So this is a lot of very valuable information. Rick, I want to thank you again for coming on the show. This is a very, very hot time right now where people are nervous. So your insight and you have the insight with all the data is very valuable. So thank you again for taking the time and coming on the show and talking to our viewers.
Happy to do it. I'm happy to do it again sometime soon. So take care, guys.
All right. Take care. Bye-bye.
Bye-bye.
Well, we told you. We told you it was going to be good.
Didn't we tell you? Because we told you.
I hope you took some information. You wrote down those states that he said he wouldn't say, but he said the states in the end. Did you?
Yeah.
I know you pulled out your pen right away.
Yeah, I got a couple. So personally, I mean, you never think of Alabama, but it's like you got millions of people
Tennessee,
living there.
Michigan.
Yeah. I mean, Florida, obviously everybody knows Florida is hot, but I don't know. Alabama is something about Alabama calling me.
Well, anyways, that was a great episode. I don't think there's anything more we can add. That was some valuable information. Hopefully you enjoyed it. If you did, please like the video. Help us out. It helps the channel. Subscribe if you're not already. And any final words before we wrap it up?
Yeah, if you didn't like the episode, watch it again and again until you see some value in it, because data is everything right now. That's why they're so powerful. They're a huge company.
It's a gold mine.
Yeah.
All right, guys. Till the next time. Thank you for watching. And over here on the side, on one of these sides, I can't tell anymore, there's going to be some videos that YouTube thinks you're going to like. So click on one of those.
Let's go.